You wake up in 2026, check your phone, and instead of calling a financial advisor, an AI has already rebalanced your portfolio, optimized your taxes for the year, and adjusted your retirement contributions based on last night's market movements. No meetings, no fees that eat into your returns, no human bias, just cold, calculated precision. The question is no longer whether artificial intelligence can manage money. The real question is whether it can do it better than humans, and if so, what happens to the millions of investors who've relied on traditional advisors for decades? For years, financial advisors have been the gatekeepers of wealth-building strategies, helping clients navigate everything from 401k allocations to tax loss harvesting and long-term retirement planning. But AI-driven platforms have quietly evolved from simple robo-advisors into sophisticated systems capable of analyzing massive datasets in real time. These systems don't just look at your age and risk tolerance. They factor in inflation trends, Federal Reserve policy signals, global market sentiment, and even behavioral patterns tied to spending and saving. Unlike human advisors, who might review your portfolio quarterly, AI can make micro-adjustments every second the market is open, potentially capturing opportunities that humans simply cannot react to fast enough. What makes AI money managers particularly disruptive is their cost structure. Traditional advisors often charge around 1% of assets under management, which might not sound like much until you realize that over decades, it can cost hundreds of thousands of dollars in lost compound growth. AI platforms, on the other hand, operate at a fraction of that cost, sometimes offering services for near zero fees or bundling them into broader financial ecosystems. For younger investors trying to build wealth or improve their FICO score while managing student loans and credit cards, this low-cost entry point is incredibly appealing. But performance is where the real battle begins. AI systems excel at removing emotional bias, one of the biggest reasons retail investors underperform the market. Panic selling during downturns or chasing hype during bull runs are behaviors that algorithms simply don't have. They stick to data, probabilities, and long-term optimization. In theory, that should lead to better outcomes. However, markets are not purely mathematical systems. They are driven by human psychology, political decisions, and unpredictable events. While AI can process historical patterns, it cannot fully predict black swan events or sudden regulatory changes from institutions like the IRS that may reshape tax strategies overnight. There's also the trust factor. Money is deeply personal, and for many investors, the idea of handing over life savings to an algorithm feels risky, even if the data suggests otherwise. Human advisors provide something AI still struggles to replicate: empathy, reassurance, and the ability to tailor advice based on nuanced life situations. A seasoned advisor can sit down with a client, understand family dynamics, business ambitions, and personal fears, then craft a strategy that goes beyond numbers. AI may recommend maximizing a Roth IRA or adjusting asset allocation, but it won't truly understand the emotional weight behind those decisions. Regulation is another piece of this puzzle. As AI takes on a larger role in financial decision-making, governments and regulatory bodies are stepping in to ensure transparency and accountability. Questions around liability become critical. If an algorithm makes a decision that leads to significant losses, who is responsible? The developer, the platform, or the user? These are not theoretical concerns. They are shaping the future legal framework of AI-driven finance right now. Interestingly, the future may not be about replacement at all, but integration. Many financial advisors are already using AI as a tool rather than viewing it as a threat. Hybrid models are emerging, where AI handles data analysis, portfolio optimization, and tax efficiency, while human advisors focus on relationship management and strategic planning. This combination could offer the best of both worlds: the speed and precision of algorithms paired with the judgment and personalization of human experience. As we move deeper into 2026, the financial landscape is clearly shifting. AI money managers are not just an alternative, they are becoming a standard. For tech-savvy investors, especially those comfortable managing finances through apps and digital platforms, the transition feels natural. For others, the shift may take more time. But one thing is certain, the days of relying solely on traditional financial advisors are fading. So, can algorithms replace financial advisors? The honest answer is not entirely, but they don't have to. They're already outperforming in speed, cost, and data-driven decision-making. The real transformation lies in how